I have made $213,000 in the past 3 months of trading, and I didn't use any fancy indicators, no random trend lines, just pure price action, baby. You see, every single day something very specific happens at the open and close of the market. And if you get good at spotting it, you can make a ton of money. Step 1. First, you need to get on a charting platform. If you don't yet have one, I like to use TradingView. Once you're on your charting platform, go to the 1 hour time frame. Next, you're going to mark out the previous trading day. On this chart, this whole area was yesterday's price action. Next, you're going to mark the previous day's low and the previous day's high. The reason why we're doing this is because there's lots of liquidity resting above and below these areas. To understand liquidity, you can think of it as areas with large open orders in the market. It's basically just an area with a lot of stop losses and buy orders. In other words, lots of money. There will naturally be a lot of stop losses right here at the previous day's low, and there will naturally be a lot of take profits at the previous day's high. That's just a given. One of the greatest lessons I've learned in my 10 years of trading is, in order to be successful at trading, you need to be entering where most people are exiting. In essence, liquidity is just that. So when trading, you basically want to try to trap buyers or sellers and use their stop losses as fuel to drive the price in the opposite direction. All the algorithms in the market are doing just this, targeting highs and lows because it wants to target the liquidity. It wants to target the orders. It wants to target the money naturally sitting in the market, and once it does, it'll naturally want to trade in the opposite direction. So often when price targets these highs and lows, this is where price will most likely reverse because of what I just taught you. So if price ever breaks highs, you should look for confluences to enter a short trade. If price ever breaks lows, you should look for confluences to enter a long trade. So going back to our example, we have our previous day's high and a previous day's low. And again, naturally, lots of resting liquidity will be above and below these areas. Price can do anything from here. We aren't trying to predict price, we're trying to read it. So in this example, price breaks the previous day's low, which brings us to step number 2. Once price has broken the previous day's high or low, you're going to go from the 1 hour time frame to the 5 minute time frame. If price broke the previous day's low, you would be looking for longs. If price breaks the previous day's high, you would be looking for shorts. In this case, price broke the previous day's low, so we'll be looking for a long trade. Now, we don't want to simply enter a long trade just because it broke the low. We first want confirmation. Once price breaks the previous day's low, you want it to immediately do a break of structure to the upside, which is just a break of the previous high. But an important step, you have to make sure this break of structure occurs above the liquidity. If it did something like this, where it did a break of structure but it was below the liquidity, this would not count. It has to do the break of structure above the liquidity. Another important note, when it does this break of structure, a candle must close above the previous high. If it just wicks above it, like this would also not count. So just to make it extremely clear, for step number 2, you must get a break of structure that not only occurs above the liquidity, but also a candle that closes above the previous high, which in this case, it does both of those. Now we need a place to enter the trade, which brings us to step number 3. But before we get into the next step, quick thing, because this entire strategy lives and dies by your stop loss. Your stop goes below the lows, your target sits at the previous day's high, and your whole edge is that risk to reward. But here's what quietly wrecks most traders. They nail the setup and then size the trade wrong. Too big, and one stop out erases a week of gains. If you trade futures on NinjaTrader, I built a tool called SizeWise that handles this for you. You set your risk in percent, it reads your stop distance, and it places the exact position size automatically, so you're never oversized on a trade again. Links in the description if that sounds useful. All right, step number 3. Usually when price does this break of structure, it'll leave behind a fair value gap. Quick refresher in case you're new. A fair value gap is just an imbalance. A 3-candle sequence where price moves so fast it leaves a gap between the wicks of the first and the third candle. It marks an area price often comes back to fill before continuing. That's all you need to know for this. When price did the break of structure, it left behind a bullish fair value gap. Wait for price to come down to this fair value gap. Once price gets here, we move to the next step. Enter the trade. Stop loss below the lows, and you're going to set your take profit at the previous day's high we marked before. And just like that, we got a winning trade. So here we have our 1 hour price action. We mark out the previous day's low and the previous day's high. We know there will be lots of resting liquidity above and below these areas. Step 2, we move from the 1 hour time frame to the 5-minute time frame. We wait for price to break in either direction. This time we broke above the previous day's high. So this time we'll look for shorts. Step number 3, wait for a break of structure directly after the liquidity grab. In this case, the break of structure must happen below the liquidity, and again, the candle must close below the break of structure. Next, we mark out our bearish fair value gap. Wait for price to come back up to it, set our stop loss above the highs, set our take profit at the previous day's low we marked out before. And again, we got an easy winning trade. So now that you guys understand the strategy, I'm going to show you some bonus tips to not only make the strategy easier, but also perform better. Bonus tip number 1. Remember how we marked out the previous day's high and the previous day's low? Well, what if I told you there's a way to do it automatically? Go on TradingView, go to the indicators, search previous days, highs and lows. I personally like this one. Now, instead of having to mark out the previous day's high and lows manually, this indicator does it for you. The green line is the previous day's high, the red line is the previous day's low. Pretty neat. Bonus tip number 2. One of the reasons this strategy works so well is because every time you use it, the risk reward is normally pretty good, meaning your losses are super small when you do lose, but your wins are super big when you win. That's the entire edge. To make this edge even greater, I have a rule. If the risk reward is not better than 2.5 to 1, I do not take the trade, meaning your take profit should be 2.5 times bigger than your stop loss every time. If it's anything less than that, you should not be taking the trade. To easily figure this out, go to the left-hand side, choose this icon, click long position, mark out your take profit and your stop loss. This risk-reward ratio number should be bigger than 2.5. If you got all the previous steps done right, but the risk-reward is under 2.5, you do not take the trade. Well, that's the strategy. Go try it out and let me know how it works for you. See you next time.